These are 5 hacks to value a commercial property in Australia, and that is useful if you're looking to buy a commercial property. Now, before I begin, let's separate what's a residential property versus a commercial property. Let's go. So right off the bat, let's differentiate between the difference of a commercial property and a residential property, which I call resi property, okay? So a residential property is basically where someone lives or where you live, all right? So basically it could be a house, a unit, an apartment, townhouse, villa, etc. If you're a landlord, it's where your tenants are living and they're paying you rent. Now, the key difference between a resi property and a commercial property, the resi property, the extent of making money is basically your tenants paying you rent, but you can't operate a convenience store inside your apartment or your house, or you can't operate a business practice in there. You got to go to a commercial property to involve that type of activity. So the type of security under a commercial property, for example, our office, it's a classic example. So for example, you're 9 to 5, you're returning back to work, you got to go back to your bloody office. If you have storage and you're a business owner, you have a warehouse where you store your stuff. For example, you're a factory worker, then a factory, childcare center, and also brothels. Now, unlike a residential property where the valuer goes out and looks at the last 3 months comparable sales to value that residential property, commercial has 5 ways of approaching a valuation. And approach number 1 is the income capitalization approach, which is purely based on rental return. So what you need to do is first, number 1, get the net operating income, which is the NOI, which is derived from rental income, which is what the annual income is, or you can get the weekly income times by 52, minus the expenses, the operating expenses. For example, the annual income of a office paid by the tenant of the office is $50,000, and the net operating expense of the levies and all that stuff that to run this office is $5,000. So you're left with an NOI of $45,000. So after you figure out the NOI, which is the net operating income, you move to step 2. You have to work out the capitalization rate, so which is also known as the cap rate in short. So the cap rate, you got to do a bit of research, which means you got to look at 6 to 10 comparable sales, similar commercial properties like the office, and work out, for example, their yield. And the way to work out the yield is you get the rental income over the market value. And for example, the cap rate over here is, for example, 5%. You then move on to step 3, which is the final step of the income capitalization approach. You get the NOI, which is the 45K divided by the cap rate, which is 5%. 45,000 over 5%, it will be 900K. So then you match this to the contract of sale or the agent's, advertised value. Now, mind you, the income capitalization approach is very rigid because every business you buy is very unique. For example, you buy an office versus you buy a brothel. Totally different businesses, totally different returns, totally different risks. So just use this as like a grain of salt. Take it as a grain of salt. But obviously, this is part of your due diligence when buying a commercial property because of every commercial property is unique. But there are obvious signs, for example, the contract of sale or what the agent is able to accept in terms of offer for this type of property. For example, offers is $1.5 million, but you do this income capitalization approach and you end up with 900K. You got to look at why is it a variance. Leading to approach number 2, it's much more simpler. You look at comparable sales. So you get the average price per square meter, which means you got to do a lot of comparable sales research on similar properties like for example, the office you're buying. And you get the average price per square meter times the property size. For example, the property size is about 100 square meter, whatever, then it works out the figure for you. Now, I'm not going to be bothered to give you an example on this because it's pretty much common sense, and it's usually the second approach after I do this approach for the income capitalization. Now, the third approach is the summation method. Now, for this method, I don't really recommend it. It's pretty hard because you got to work out, the components added together. For example, you got to work out what is the land value, the construction improvements of the building, the fixtures, the landscaping, and then you gotta know the land size, the age, the condition, the energy efficiency. You gotta add that all together, break it all down, and add it together into one final value. And to be honest, guys, even that's pretty freaking hard for myself. And I'm pretty cluey and been in the industry for the last 15 years. And that's pretty not what I recommend for noob first-time commercial investors. Now, going to the fourth approach, it's called the replacement cost method, and it's pretty much very simple. It's how much it costs to replace the entire building. Sometimes you can cheat and just look at the insurance policy, the building insurance on this existing property, and then sort of work out from there what is the replacement cost. Now again, guys, that's really the the perspective from an insurance company replacing that building. It might not be a very accurate figure in terms of market value, but again, take it with a grain of salt and add it towards the other evaluation methods, for example, the comparable sales method and the income capitalization method, to make your own judgment. And last but not least is the future development method. And I really suggest this for, I guess, green to wannabe developers, because this is usually for more knockdown and rebuild. For example, you purchase a commercial vacant piece of land, you got DA, and you want to work out before you buy it, when you do your due diligence, whether the values add up. So quickly, to work this out, pretty complicated, but you'll work out the final market value of this vacant land plus the build. And then you minus the selling expenses, for example, agent fees and stuff to sell your property. You get the net realization. And then from there, you get the net realization minus developer's profit margin, which will equal to your total capital. And then from total capital minus your development cost equals your total value. Again, the fifth approach is more of a feasibility study when you approach a piece of land commercially to build and see whether it's viable. That usually requires a bit more experience. I recommend, if you're buying more established property, that you use the income capitalization approach, the comparable sales approach, and also add on the replacement cost approach. And as a disclaimer, guys, this is not the bank's way of valuing the property. The banks is always more conservative. This is for you before you go and purchase that property, to do your own due diligence before you then go get a pre-approval and then buy the property and get it valued. All right, so jump in the comments, let me know if you have any questions.